The International Monetary Fund is an international organization headquartered in Washington, D.C., of 188 countries working to foster global monetary cooperation, secure financial stability, facilitate international trade, promote high employment and sustainable economic growth, and reduce poverty around the world. Formed in 1944 at the Bretton Woods Conference, it came into formal existence in 1945 with 29 member countries and the goal of reconstructing the international payment system. Countries contribute funds to a pool through a quota system from which countries experiencing balance of payments difficulties can borrow money. As of 2010 update, the fund had XDR $476.8 billion, about $755.7 billion at then current exchange rates. Through the fund, and other activities such as statistics keeping and analysis, surveillance of its members' economies and the demand for self-correcting policies, the IMF works to improve the economies of its member countries. The organization's objectives stated in the Articles of Agreement are to promote international monetary cooperation, international trade, high employment, exchange rate stability, sustainable economic growth, and making resources available to member countries in financial difficulty. Functions. According to the IMF itself, it works to foster global growth and economic stability by providing policy, advice and financing to members, by working with developing nations to help them achieve macroeconomic stability and reduce poverty. The rationale for this is that private international capital markets function imperfectly and many countries have limited access to financial markets. Such market imperfections, together with balance of payments financing, provide the justification for official financing, without which many countries could only correct large external payment imbalances through measures with adverse economic consequences. The IMF provides alternate sources of financing. Upon the founding of the IMF, its three primary functions were to oversee the fixed exchange rate arrangements between countries, thus helping national governments manage their exchange rates and allowing these governments to prioritize economic growth, and to provide short-term capital to aid balance of payments. This assistance was meant to prevent the spread of international economic crises. The IMF was also intended to help mend the pieces of the international economy after the Great Depression and World War II, as well to provide capital investments for economic growth and projects such as infrastructure. The IMF's role was fundamentally altered by the floating exchange rate post-1971. It shifted to examining the economic policies of countries with IMF loan agreements to determine if a shortage of capital was due to economic fluctuations or economic policy. The IMF also researched what types of government policy would ensure economic recovery. The new challenge is to promote and implement policy that reduces the frequency of crises among the emerging market countries, especially the middle-income countries that are vulnerable to massive capital outflows, rather than maintaining a position of oversight of only exchange rates. Their function became one of surveillance of the overall macroeconomic performance of member countries. Their role became a lot more active because the IMF now manages economic policy rather than just exchange rates. In addition, the IMF negotiates conditions on lending and loans under their policy of conditionality, which was established in the 1950s. Low-income countries can borrow on concessional terms, which means there is a period of time with no interest rates. Through the Extended Credit Facility, the Standby Credit Facility and the Rapid Credit Facility. Non-concessional loans, which include interest rates, are provided mainly through standby arrangements, the Flexible Credit Line, the Precautionary and Liquidity Line, and the Extended Fund Facility. The IMF provides emergency assistance via the Rapid Financing Instrument to members facing urgent balance of payments needs. Surveillance of the global economy. The IMF is mandated to oversee the international monetary and financial system and monitor the economic and financial policies of its member countries. This activity is known as surveillance and facilitates international cooperation. Since the demise of the Bretton Woods system of fixed exchange rates in the early 1970s, surveillance has evolved largely by way of changes in procedures rather than through the adoption of new obligations. The responsibilities changed from those of guardian to those of overseer of members' policies. The fund typically analyzes the appropriateness of each member country's economic and financial policies for achieving orderly economic growth, and assesses the consequences of these policies for other countries and for the global economy. In 1995, the International Monetary Fund began work on data dissemination standards with the view of guiding IMF member countries to disseminate their economic and financial data to the public. The International Monetary and Financial Committee endorsed the guidelines for the dissemination standards, and they were split into two tiers: the General Data Dissemination System and the Special Data Dissemination Standard. The Executive Board approved the SDDS and GDDS in 1996 and 1997 respectively, and subsequent amendments were published in a revised guide to the General Data Dissemination System. The system is aimed primarily at statisticians and aims to improve many aspects of statistical systems in a country. It is also part of the World Bank Millennium Development Goals and Poverty Reduction Strategic Papers. The primary objective of the GDDS is to encourage member countries to build a framework to improve data quality and statistical capacity building in order to evaluate statistical needs, set priorities in improving the timeliness, transparency, reliability and accessibility of financial and economic data. Some countries initially used the GDDS, but later upgraded to SDDS. Some entities that are not themselves IMF members also contribute statistical data to the systems. Palestinian Authority, GDDS. Hong Kong, SDDS. Macau, GDDS. EU institutions. The European Central Bank for the Eurozone, SDDS. Eurostat for the whole EU, SDDS, thus providing data from Cyprus and Malta. Conditionality of Loans IMF. Conditionality is a set of policies or conditions that the IMF requires in exchange for financial resources. The IMF does require collateral from countries for loans, but also requires the government seeking assistance to correct its macroeconomic imbalances, in the form of policy reform. If the conditions are not met, the funds are withheld. Conditionality is perhaps the most controversial aspect of IMF policies. The concept of conditionality was introduced in a 1952 Executive Board decision and later incorporated into the Articles of Agreement. Conditionality is associated with economic theory as well as an enforcement mechanism for repayment, stemming primarily from the work of Jacques Pollack. The theoretical underpinning of conditionality was the monetary approach to the balance of payments. Structural adjustment. Some of the conditions for structural adjustment can include cutting expenditures, also known as austerity, focusing economic output on direct export and resource extraction, devaluation of currencies, trade liberalization, or lifting import and export restrictions, increasing the stability of investment, balancing budgets and not overspending, removing price controls and state subsidies, privatization, or divestiture of all or part of state-owned enterprises, enhancing the rights of foreign investors vis-à-vis national laws, improving governance and fighting corruption. These conditions have also been sometimes labeled as the Washington Consensus. Benefits. These loan conditions ensure that the borrowing country will be able to repay the IMF and that the country will not attempt to solve their balance of payment problems in a way that would negatively impact the international economy. The incentive problem of moral hazard, when economic agents maximize their own utility to the detriment of others because they do not bear the full consequences of their actions, is mitigated through conditions rather than providing collateral. Countries in need of IMF loans do not generally possess internationally valuable collateral anyway. Conditionality also reassures the IMF that the funds lent to them will be used for the purposes defined by the Articles of Agreement and provides safeguards that country will be able to rectify its macroeconomic and structural imbalances. In the judgment of the IMF, the adoption by the member of certain corrective measures or policies will allow it to repay the IMF, thereby ensuring that the resources will be available to support other members. As of 2004 update, borrowing countries have had a very good track record for repaying credit extended under the IMF's regular lending facilities with full interest over the duration of the loan. This indicates that IMF lending does not impose a burden on creditor countries, as lending countries receive market-rate interest on most of their quota subscription, plus any of their own currency subscriptions that are loaned out by the IMF, plus all of the reserve assets that they provide the IMF. History. The IMF was originally laid out as a part of the Bretton Woods System Exchange Agreement in 1944. During the Great Depression, countries sharply raised barriers to trade in an attempt to improve their failing economies. This led to the devaluation of national currencies and a decline in world trade. This breakdown in international monetary cooperation created a need for oversight. The representatives of 45 governments met at the Bretton Woods Conference in the Mount Washington Hotel in Bretton Woods, New Hampshire, in the United States, to discuss a framework for post-war international economic cooperation and how to rebuild Europe. There were two views on the role the IMF should assume as a global economic institution. British economist John Maynard Keynes imagined that the IMF would be a cooperative fund upon which member states could draw to maintain economic activity and employment through periodic crises. This view suggested an IMF that helped governments and to act as the U.S. government had during the New Deal in response to World War II. American delegate Harry Dexter White foresaw an IMF that functioned more like a bank, making sure that borrowing states could repay their debts on time. Most of White's plan was incorporated into the final acts adopted at Bretton Woods. The IMF formally came into existence on the 27th of December 1945, when the first 29 countries ratified its Articles of Agreement. By the end of 1946, the IMF had grown to 39 members. On the 1st of March 1947, the IMF began its financial operations, and on the 8th of May France became the first country to borrow from it. The IMF was one of the key organizations of the international economic system. Its design allowed the system to balance the rebuilding of international capitalism with the maximization of national economic sovereignty and human welfare, also known as embedded liberalism. The IMF's influence in the global economy steadily increased as it accumulated more members. The increase reflected in particular the attainment of political independence by many African countries and more recently the 1991 dissolution of the Soviet Union because most countries in the Soviet sphere of influence did not join the IMF. The Bretton Woods system prevailed until 1971, when the U.S. government suspended the convertibility of the U.S. dollar into gold. This is known as the Nixon shock. Since 2000 in May 2010, the IMF participated, in 3/11 proportion, in the first Greek bailout that totaled €110 billion, to address the great accumulation of public debt, caused by continuing large public sector deficits. As part of the bailout, the Greek government agreed to adopt austerity measures that would reduce the deficit from 11% in 2009 to well below 3% in 2014. The bailout did not include debt restructuring measures such as a haircut, to the chagrin of the Swiss, Brazilian, Indian, Russian, and Argentinian directors of the IMF, with the Greek authorities themselves ruling out a haircut. A second bailout package of more than €100 billion was agreed over the course of a few months from October 2011, during which time Papandreou was forced from office. The so-called Troika, of which the IMF is part, are joint managers of this program, which was approved by the executive directors of the IMF on 15 March 2012 for SDR $23.8 billion, and which saw private bondholders take a haircut of upwards of 50%. In the interval between May 2010 and February 2012, the private banks of Holland, France and Germany reduced exposure to Greek debt from €122 billion to €66 billion. As of January 2012, the largest borrowers from the IMF in order were Greece, Portugal, Ireland, Romania, and Ukraine. On 25 March 2013, a €10 billion international bailout of Cyprus was agreed by the Troika, at the cost to the Cypriots of its agreement to close the country's second-largest bank, to impose a one-time bank deposit levy on Bank of Cyprus uninsured deposits. No insured deposit of €100,000 or less were to be affected under the terms of a novel bail-in scheme. The topic of sovereign debt restructuring was taken up by the IMF in April 2013 for the first time since 2005, in a report entitled Sovereign Debt Restructuring: Recent Developments and Implications for the Fund's Legal and Policy Framework. The paper, which was discussed by the board on 20 May, summarized the recent experiences in Greece, St. Kitts and Nevis, Belize, and Jamaica. An explanatory interview with Deputy Director Hugh Bredenkamp was published a few days later, as was a deconstruction by Martina Stevis of The Wall Street Journal. In the October 2013 Financial Monitor publication, the IMF suggested that a capital levy capable of reducing euro area government debt ratios to N2007 levels would require a very high tax rate of about 10%. The Fiscal Affairs Department of the IMF, headed by Dr. Sanjeev Gupta, produced in January 2014 a report entitled Fiscal Policy and Income Inequality, which stated that some taxes levied on wealth, especially on immovable property, are also an option for economies seeking more progressive taxation. Property taxes are equitable and efficient, but underutilized in many economies. There is considerable scope to exploit this tax more fully, both as a revenue source and as a redistributive instrument. At the end of March 2014, the IMF secured an $18 billion bailout fund for the Provisional Government of Ukraine in the aftermath of the 2014 Ukrainian Revolution. Member countries. Not all member countries of the IMF are sovereign states, and therefore not all member countries of the IMF are members of the United Nations. Amidst member countries of the IMF that are not member states of the UN are non-sovereign areas with special jurisdictions that are officially under the sovereignty of full UN member states, such as Aruba, Curaçao, Hong Kong, and Macau, as well as Kosovo. The corporate members appoint ex officio voting members, who are listed below. All members of the IMF are also International Bank for Reconstruction and Development members and vice versa. Former members are Cuba and the Republic of China, which was ejected from the UN in 1980 after losing the support of then U.S. President Jimmy Carter and was replaced by the People's Republic of China. However, Taiwan Province of China is still listed in the official IMF indices. Apart from Cuba, the other UN states that do not belong to the IMF are Andorra, Liechtenstein, Monaco, Nauru, and North Korea. The former Czechoslovakia was expelled in 1954 for failing to provide required data, and was readmitted in 1990, after the Velvet Revolution. Poland withdrew in 1950, allegedly pressured by the Soviet Union, but returned in 1986. Qualifications: any country may apply to be a part of the IMF. Post-IMF formation, in the early post-war period, rules for IMF membership were left relatively loose. Members needed to make periodic membership payments towards their quota, to refrain from currency restrictions unless granted IMF permission, to abide by the Code of Conduct and the IMF Articles of Agreement, and to provide national economic information. However, stricter rules were imposed on governments that applied to the IMF for funding. The countries that joined the IMF between 1945 and 1971 agreed to keep their exchange rates secured at rates that could be adjusted only to correct a fundamental disequilibrium in the balance of payments, and only with the IMF's agreement. Some members have a very difficult relationship with the IMF, and even when they are still members, they do not allow themselves to be monitored. Argentina, for example, refuses to participate in an Article 4 consultation with the IMF. Benefits: member countries of the IMF have access to information on the economic policies of all member countries, the opportunity to influence other members' economic policies, technical assistance in banking, fiscal affairs, and exchange matters, financial support in times of payment difficulties, and increased opportunities for trade and investment.